Good morning, everybody. It's an absolute pleasure to be back for the second edition of the Digital Assets Forum here in London, and to be back on stage with many friendly faces. So welcome all. I'm particularly excited to kickstart this panel on crypto custody. It's been a central piece of programs at Global Digital Finance for the past few years, so very close to heart and a lot of the work that I do in a day-to-day. But before we get into any of that, can I please ask the panel to just do a quick round of intros? Laurent, do you want to go ahead?
Of course. Good morning, London. Good morning to all of you. So a pleasure to be with you today. I just celebrated my 10 years in the crypto and tokenization industry. So I recently joined a month ago Standard Chartered as a CEO based in Luxembourg, where we just received the VASP registration in Luxembourg.
Hi, everybody. My name is Alessandro. I'm here representing the crypto-native broker and custodian of the Deutsche Börse Group, a company called Crypto Finance, founded originally in 2017, and later on in 2021 acquired. And so today we represent effectively the digital asset central place around which the digital asset strategy of the broader group has been formulated. And it's very exciting to be here once again.
Hi, everyone. My name is Lior Lamesh. I'm co-founder and CEO at GK8. My background is cybersecurity at the level of national security. At GK8, we started our journey over 6 years ago when we hacked one of the most popular cold storage in the market, and we managed to come up with a new security category called impenetrable custody in order to make blockchain communication without being connected to the internet. We're pairing this technology along with the MPC, and we are working with leading financial institutions, providing them with our platform so they can offer services such as custody, staking, tokenization, and DeFi. Starting March of 23, we joined forces with the Galaxy Digital, which acquired the company, so we're fully owned by them. Yeah, I'm very excited to be here.
Wonderful. Good morning, guys. Alex, I head up Bitpanda Custody, which used to be Trustology before it became Bitpanda Custody. Not dissimilar journeys, I guess. We all got bought up. I noticed that I'm the only one with the bag underneath me. Must be habit, being custodian. But anyway, I don't trust anybody with my bag. So Bitpanda is a retail broker. We also have the institutional arm, so we do white label brokerage and trading APIs, as well as institutional and retail custody. And look forward to the panel. Thank you.
Hello, very pleased to be here. I'm Mico. I'm managing the DLT and Digital Asset Competence Center for Banca Sella. Banca Sella is a 140 years old bank, active in Italy, so quite an established player. And we are working a lot both on custody, e-money token issuance, and many more interesting stuff.
Super. Well, thanks, everybody. I think one of the really nice things that we have here today is that we have a pretty broad array of different kind of market participants here, which is always nice to get a diverse panel. So I think one of the themes that just came across really strongly in the last panel is also the topic of my next panel in a couple of hours, is the theme of convergence between, broadly speaking, the world of digital assets and TradFi. And I think one of the linchpins of that is custody. So it's really a central theme to this greater convergence movement in market that we're seeing. And so I think I just want to take a bit of a step back to kickstart the panel and to just try and understand why that is. And I mean, from my perspective, it's the role that custody does in terms of fostering trust in the market. But Laurent, I'd love to get your perspective wearing different hats on that suggestion.
Okay, thank you. Do you know why I decided to join SCB?
Tell us.
No, because I'm more than convinced that the custody has a role to play in terms of trust for the digital asset industry. So why do I believe that is firstly, the traditional custody, we have years and decades of trust related to the security, to the cyber security. We have also years and decades to manage regulation. So since 2008, you imagine the number of pages and the number of regulation we have to deal with. And especially now in the digital asset industry, it's quite important to deal with regulation. And we are in the center of MiCA now, so obviously it's very important. And also in terms of trust, what is very important is we have also years and decades to manage interoperability, connection between different custodians. So interoperability is a key topic for the digital asset industry. So we have the experience of that, and also we have clients already since decades. So this is why I believe there is something to do with the traditional custody in the digital asset space.
Yeah. So eventually, what custody is about private keys, right? And if private keys are being stolen when trying to communicate with the blockchain, then money can be gone and the trust is gone. So basically, custody is the root of trust, right? How many times, let's say, financial institution can afford themselves to be hacked? Probably not even once, right? Not for the money that's being stolen and not for the reputation. And the situation right now is that trust should be the most valuable asset for these financial institutions. And if we want to encourage more and more new crypto investors to join the market, we need to establish the trust. If we want people that not necessarily the tech people like our parents or others to join this market, they need to feel this trust. But currently the situation is not necessarily like that, right? We've seen over the last years billions of dollars that have been stolen from mainly crypto exchanges and other institutions that didn't necessarily manage their private keys properly. Just last year, we've seen some of the massive cyber attacks on private keys, such as in WazirX, one of the largest Indian exchanges, where over $200 million been stolen. They used multi-sig solution. We've seen DMM, one of the largest Japanese exchanges, they were hacked for over $300 million, and they used cold wallets. And even a few years ago, we've seen another crypto exchange, Liquid, in Japan, that was hacked for around $100 million, and they used MPC. Right, so clearly the situation right now is that there is no enough trust, so and it needs to be changed. And for us at GK, the reason we come up with the impenetrable custody approach is not just as a security manner, but it's the foundation for a sustainable digital assets ecosystem. We believe that in order to protect the future of money, you need to set up a foundation that cannot be hacked, and that's the way to achieve trust.
Yeah, I mean, I couldn't agree more, but I would I'd maybe challenge your perspective a little bit on the evolution that we've seen in the past few years. The points that you made on the incidents in the past year, 2 years, are totally correct, but I do think there has been sort of greater confidence in terms of custody solutions in the market. And so that very coincidentally brings me to my next question, which I wanted to turn to Mico, Alessandro, and Alex around what has that evolution really looked like. So, I mean, Alex, you mentioned the market movements in terms of companies being bought out or M&A scene. Alessandro, as a subsidiary, you obviously have an interesting perspective there as well. So, it'd just be great to get your views on your perspective of the evolution of custody in the past few years.
I'll kick it off first. So I think the concept of trust is important, but it's who do you place this trust in? And back in 2017, when at least in Europe you started seeing the first couple of institutional players that were providing either sub-custodial services or were providing technology, it was a bit new to how, the way custody was being approached was a little bit new and different from the way traditional capital markets were being approached. You no longer had these massive custodians that were safekeeping the private keys that were discussed a second ago by Lior. But you were dealing with small balance sheets. You had higher counterparty risk due to the limited track record of a lot of these players. And so what started happening quite a bit, Crypto Finance in a previous version had an entity called Crypto Storage, which was providing infrastructure. Those were also the years where Taurus was founded. Companies like Fireblocks started gaining traction, Metaco, etc. So you had these technology providers which were ultimately empowering third-party institutions to be their own custodians. Now, this was a little bit odd, and it's not really something that a lot of the larger financial institutions were used to because they used to rely on slightly larger players sitting behind the scenes taking care of it, be that a CSD like Clearstream, be that a global custodian bank. There's many out there. Now, the counterparty risk was too high, so there was this tendency to insource and to ultimately place more trust in the direct management of the wallet infrastructure. Of course, as the time went by, more regulation came into play, even though it was incredibly fragmented, especially here in Europe. Switzerland, I think, was a little bit of a guinea pig and an early adopter in standardizing things. You started seeing a lot of these crypto natives become more powerful, growing and ultimately offering very robust solutions where key loss wasn't as big of an issue anymore, and mismanagement of keys wasn't really an issue anymore. So all of a sudden, the trust was no longer in-source, but started being placed externally. Now, depending on who you are, there's different use cases, and I think both models have a place and will have a place in the future where they will be able to coexist. And to end my thought, this is where I think 2025 and the Trump presidency over in the United States, the entry into effect of MiCA, is finally generating enough certainty in the market for also the traditional players, traditional custodian, be that a Standard Chartered, be that other entities, are coming into the market, leveraging existing rails, and ultimately providing the extra layer of crypto custody. And so I think anyone who's now coming into the market will be able to pick and choose what suits them best. In my mind, as a representative of an entity that provides both custodial services as well as technology, oftentimes there's a bit of a trade-off. Do you want to have a Ferrari for a Fiat use case, which is probably the case today, right? Most intermediaries are now launching closed-loop Bitcoin and Ethereum trading and custody, so you probably don't need the incredibly exciting technology that companies like GK8 provides, crypto finance on the self-custody setup provides. But you also want to make sure that you can future-proof yourself. And we all know how long the onboarding with a big bank is. And so generally they want to make sure that you're ready to grow together with the needs of their customers. So I think there's these three different approaches. You got a traditional custodian that's entering the space offering crypto custody. You've got crypto native custodians, which obviously now have 10-year track records. And then you have self-custody providers, which obviously can empower you to be your own custodian.
Very few words to add, because I completely share the view of my colleagues. I believe that something happened in the last 2 years when banks started to deal with this technology counterpart in terms of let this technology counterpart share the approach that banks has towards compliance. Entering and breaking down exactly what does it mean to then have a living process around digital asset custody. And on the other hand, the technology provider proved that this new solution could fit already existing frameworks that banks traditionally have custodying assets. What I now see is that also the workforce of both parties is transforming very, very rapidly. So we are seeing many crypto people entering the banking world, and we are seeing people that spend 20 or 30 years in IML or in compliance in banks entering the crypto companies. And I believe that together with new projects getting to the market, this will be like the pivotal time.
Well, that was the short term. I'll bore the hell out of you if I talk about the short term. So longer term, what do I think is going to happen? Let's start with a story. There's about 4 years ago, big bank in UK went down, and there was a story about a father saying that he could not buy milk for his newborn baby. That's quite serious, isn't it? If an outage causes a baby to die, I know that's kind of an extreme case, but still, think about that. So, in principle, we've now reached a point of no return. Our digital lives are so critical to survival that if you do not have your digital identity that's secure and systems that are robust enough to record all of our actions, it could lead to critical scenarios. So what do? We've now seen the emergence of blockchains, and it's really a movement from a unicast internet, where we simply use the internet for communication between two parties, to multicast. We broadcast to a bunch of different people and shared computational and persistence models. We store data in a shared way, and we compute in a shared way. Why? It's a lot more resilient. We don't need it for everything, but for key things you do. So if we project and if we abstract the idea of blockchain to multicast communication, storage, and computation systems, well, really we've now got a backbone to pretty much anything we ever want to do in a commercial digital world. All right, what does that mean? It means that custody is actually about identity and transaction management. So I think the next evolution of custodians will transfer themselves from being purely just a digital asset to a digital identity provider. And why is that important? Because the market is absolutely huge. It blows away all your cloud computation services. It blows away most of your shops, and every bit of everything you do going forward in this digital broadcast universe is going to be managed by your private keys, and anyone storing those is going to be really, really important. So I think if you realize that the end game is not crypto assets, not even just tokens or security tokens, but every bit of economic activity, that's massive. So scaling and security at global level, billions of people using this every day, is going to be the next challenge.
That's definitely a bit of a plot twist on where we were starting with, and I mean, I think there's a lot of sense in the points that you just made. Be interested, what the sort of banking perspective is on that, actually, because I think many of the conversations that we've had with some of the more sort of institutional participants in the market is around risks of disintermediation as compared to, what a coexistence model might look like, or even a convergence model. So you don't want to put Laurent on the spot or Mico on that in particular, but the title of the panel is around what are the innovative solutions to market. So maybe we can sort of take Alex's train of thought here and just take a step back, think what is in the market right now, what's working, what's not working, and what are the innovative solutions that we think might help us get there further down the line. So very happy for you guys to make this a bit of an open conversation. But Lior, I know that we owe you a head start with the lovely drinks that you put together for everybody yesterday. So why don't you get us started?
So, from our perspective as technology providers, the way we see the need for innovative infrastructure in our space is really around the private keys side of things, as we touched here. Eventually, since we started in 2018, the main, I would say, custody technology that dominated was mainly multisig. But as in the example that I mentioned before, multisig proved to be hacked. Eventually, a few internet-connected computers just need to be hacked in order to do that. Another misleading concept that we see in the market is about MPC. MPC is secure, but is not secure by itself in order to provide the custody. It's mainly should be used for the day-to-day operation. And in order to understand how it should be different, we should also understand how hackers think, right? Hacking is a business, right? How much hackers will invest to compromise into a bank? It really depends how much you can get. It's about ROI, and hackers will invest millions to steal billions. And the basic metric that we are taking into account that I can share with you from my previous background in the Prime Minister's office is that $1 million is what hackers need to invest in average in order to compromise one public internet-connected computer. And in order to hack the current solution then, whether if it's a multi-sig with like 2 internet-connected computers that each of them hold one full key, or MPC with, let's say, 3 internet-connected computers that each of them hold 1/3 of a key, then it's enough for hacker to invest few millions in order to potentially still hundreds or billions of dollars. Now, on the other end, we see so-called cold solutions in the market, that calls are not really called during the full communication process. They are all at some point receiving input from the internet, and that's exactly the point where the call becomes hot. So also in this case, it's enough to invest like million or a few millions in order to potentially steal way more than that. And as Alessandro mentioned, that I couldn't agree more, I think with the Trump election and its effect, there will be more and more new crypto investors joining the market. And I think that this is where the banks are going to be the first choice, since that's what the market sees as the trustworthy entities. And that's where a new category for security should take place, because they cannot allow themselves to be hacked. So at GK8, with the impenetrable technology that we created, we are able to make the full process of creating, signing, and sending blockchain transactions without ever at any point receiving input from the internet. So unlike traditional cold storage, we are never exposed to any cybersecurity attack vectors. We are pairing it with UMPC, which is innovative MPC that we have, where we can split the private key into large number of shards. So instead for hackers to invest only 3 million to compromise only 3 internet-connected computers, in our case, they need to invest like 10 in order to compromise 10 different internet-connected computers. So this is how you increase the level of security. And I think that this is the innovation that we should place in the market, so banks can provide the needed level of trust also for this perspective.
If I may add, a slightly different perspective, but and I say this as a 29-year-old who tries to be as proactive about embracing ultimately the concept of sovereignty, which blockchain allows. I have a lot of different ledgers sitting at home, a lot of different MetaMask wallets, but I think the true innovation in, especially at an institutional level in custody, comes from boredom. Okay, let me explain what I mean with this. Generally, the highest attack vectors, especially when it comes to crypto assets, happen when there's an actual movement of the crypto funds. And so I think what we're going to see, and quick parenthesis, and I think for this reason and the concept of movement of assets is something that is really being catered to very heavily by the infrastructure providers. Every infrastructure provider, some of which I mentioned, you guys are probably one of them as well, has some sort of network type of service which allows for more compliant or generally more secure whitelisting that allows you to move assets from left to right. Traditionally, instead, assets typically will be concentrated in the hands of few. You know, we got Clearstream sitting here, one of our sister companies. So everything revolves around CSDs. Now, I think that kind of model is probably going to become very relevant in the crypto space as well. I don't necessarily mean it's the best thing for someone who's a hardcore blockchain maximalist, but nonetheless, I think that has a very strong value proposition. And this is what I mean with innovation in this case comes from boredom. It just happens that boredom wasn't the starting place, but it's something that is getting introduced into the market over time. Now, going back to the short term versus long term, I think what you mentioned, Alex, is incredibly exciting, but I also urge for a lot of the financial players out there to kind of get started, have the market validate the use cases. That's why closed loops today are very popular. On one hand, compliance is not as big of an issue because the assets are not really moving from left to right. They're sitting in some custodian, or if there's more custodians that a bank is relying on. And also, it's a great way to generate quite a bit of revenue. On-ramp, custody, off-ramp, and even FX. So it's a big revenue generator for some of these entities. But again, in my mind, a lot of the innovation does in fact come from boredom. There's different approaches. I mentioned some in my opening statement. And more, there are also use cases out there from banks that can induce all the FOMO that the decision makers in other entities that are on the fence can be looking for.
I mean, I think that actually ties into one of the things that I regularly say about the market is that capital markets run like capital markets do. And so, I mean, that FOMO element is actually really valid. Like, if you know your competitor is up to something in building, like, you best be prepared to be doing the same thing and delivering the same value proposition. Otherwise, the risk of disintermediation that I mentioned earlier, I think, does actually stand. If nobody has anything else to add on some of the innovative solutions...
Maybe I can just add with Gen AI. with the rise of Gen AI, we will have more and more innovative attacks in the future. So we need to have innovative solutions. We were speaking about US. So definitely for the retail, there will be a lot of attacks for retail probably in the futures, and a lot of social engineering. So I believe that we have to speak about innovative solutions for the digital asset, but also we need to speak about education, because education is sometimes one of the best way to be protected.
It is. I was actually listening to a podcast that had a speaker from somebody that I can see in this room, and it was about the sort of the greater convergence of AI agents and the influence that it's having on portfolio management, but particularly on a retail level now, and what happens in a black swan event. So I think it's a very interesting consideration as well. But maybe it leans into. Oh, Alex, please.
So, when will be the first private key injected in someone's brain with Neuralink? It will happen, you know that. So the question is, I reckon 5 years from now. Shall we take a bet?
5 years?
Yeah.
Not a chance.
Longer?
Longer.
Okay. Pint?
Straight up dinner?
Straight up dinner.
Yeah, I mean, we'll see. With the catch-ups that we have regularly at the Digital Asset Forum or the European Blockchain Convention, I think there's somebody can take the other up on that quite easily. But I guess it brings us to a point of the conversation which you can't really avoid when it comes to all things custody. And I know this all too well from the 66-page report that we put out a year and a half ago or so on custody in the context of public permissionless ledgers. A lot of it was the risk factors and what are possible risk mitigants. Unsurprisingly, though, there's a huge element there that really is around the policy and legal challenges. And so I was wondering if we could turn to maybe some of the bankers that we have here to talk about, what you perceive as the current sort of adoption challenges, but in particular some of the, reg and policy hurdles that go with trying to build out crypto custody solutions.
So as you know, to be mainstream, so we have the Gartner hype cycle. So we need to go across different stages. So now blockchain is not a baby anymore. So it's 16 years. So it's not a baby anymore. So to go mainstream, probably we need to have additional 4 or 5 years. So in terms of challenges, we have a lot of challenges, but let me focus probably on just 2 challenges. The first one, when you have a worldwide business, regulation is definitely a key challenge. Being based in Europe, so you have 27 member states. So in Europe, with different regulation now with MiCA, it's going to change a bit. But if you have a worldwide business, you need to have licenses in Europe, in US, in UK, in Asia, in different countries in Asia, and so on. So it's quite costly, in terms of business. It's very, very costly. So regulation, harmonization of regulation is definitely a key topic, but it can be a key differentiator. And the other challenge for me, in addition to the interconnectivity and so on, is change management and ability to take decision in the financial industry. Because what I have seen, we still see a lot of C-level senior people that are talking not with a good position about Bitcoin and different crypto. Bitcoin is a fraud. Bitcoin is a Ponzi scheme and so on. So we need the big C-level to have a good word. We need to build success story. And we should just not focus on defensive position, but to embrace the change and to make the future better.
I will not cover again the fragmentation topic that Laurent already said. I believe there's an internal challenge in the organization because a huge educational effort is required to have all the key functions onboarded when dealing with this topic. And especially when you then get to the outside, mainly speaking with the local regulators, you need to have at least 10 different functions involved if you want to have a clear path. And plus, on one hand, you need to deal with, let's go very bold on this, with the over-regulation we now have in Europe is crazy. The cost of complying with MiCA, it's something that doesn't fit any P&L model so far. Okay, that's why we're building a Ferrari and and then watch the television. And if I may add also, when it comes to travel rule, for example, just use it as an example. There's a clear rule that is trying to bring to the digital asset world what is already existing in payments. The scheme is very clear, theoretically speaking, but when you then get to the market, no player is available to fulfill all the requirements. So you are asking banks something that is not impossible, but is not feasible right now. So the cost of compliance grows, and you are actually not able to comply. So I believe that the results of both the internal effort and the external effort you put need to bring also local regulators to review their position, and I hope in the short term also to review what's the actual framework of a regulation, because everybody understands that that competitive advantage that Europe could have is disappearing.
And just on the travel rule, sorry, just because I lived through that hell. So the FATF was very clear. It said that national governments need to assist the program by setting up VASP directories. Did they? They did not bother. So the only thing they ever did is tell everybody else what to do, and there was no help, and that's not great. The governments have an obligation to make this better, and none of them pulled their finger out. Shame on them.
And if I may add, this is a problem of the level of service you provide to the customer in the end, because if out of 100 transactions I need to KO more than half of it, this is not a level that a bank can offer to its clients.
I want to jump in as technology providers. We see what Mico mentioned a lot. Eventually for banks that are not used to work with crypto, there are so much education that is needed, right? And as technology providers, our role eventually is to see how we can build a product in a way that is as similar as what they used to do with fiat assets or other traditional assets, such as with a policy engine where they can control the assets the same way that they do with traditional assets. And also, as technology providers, one of our main responsibilities is making sure that we will comply with the different regulation requirements, right? So we don't hold the money of no one, but we provide the technology for banks, as an example, and they need to hold the money of their clients, and they need to comply with different regulation requirements. So we need to help them to comply with that, with the way that the product is operating. So, for example, just 2 weeks ago, the DORA regulation came into effect. And it set up new standards for operational resilience, including security standards. They mention things such as business continuity plan, role-based assets control. They need to do penetration tests. And basically, they also indicate for the need to a secondary custody solution. So these are kind of things that we need to take into consideration and make sure that we meet them ahead in time, so once the regulation is coming into effect, our clients could be ready to start offering services to their clients.
And actually, just to add to that, the secondary custodian is a really interesting challenge because no one's thought through the practical implications. Let's say you got 10,000 addresses. That means 10,000 potentially transactions. 17 transactions per second? Calculate how long it will take you to migrate all of your assets from one custodian to another if you're doing it on chain. So there needs to be a complete rethink about how you do waterfall management, how do you do handover and all that kind of stuff, and none of that's been tackled. So I would thoroughly encourage the principle is the correct one. but the technical implementation that's been proposed is pretty poor right now.
So just quick, there are some, the way that we approached it is in a way first to make sure that there is like active sync between the two solutions, and that the integration with the secondary solution will be whitelist based. So you don't really need to do the technical integration, but just manage the asset that part of them will be there and the other part will be there, and you can move assets based on policy engine and whitelist.
At the risk of coming across as very superficial, I think money, once again, is a solution to all evils. Okay, let me explain. Today, it's very difficult, especially in those financial institutions that are a little bit more conservative, to get them into the asset class. Why? If they don't really see the business case, the demand, the decision maker who's probably built a career around what they've done up until that moment, who's sitting very comfortably, is not going to potentially, even though in my mind the chances are very low, throw everything down the drain because they're venturing into a completely new space. Now, what I believe, and the reason I'm saying money is the solution here, in Switzerland, where the DLT law came into effect in 2020 and effectively saw the first wave, I think there's around 40 different securities firms and banks offering crypto services today. And I'm talking about cantonal banks, which get as boring as you can think of, all the way to very exciting retail broker banks, okay? What the money and the business case allowed them to ultimately do is ultimately lobby more and get more involved with the regulator, coming to your policy angle, in order to then shape the way things were done. This was the case, for example, not too far ago. I think it was maybe end of 2023 with the staking circular. You know, staking is already regulated out in Switzerland. Mico doesn't even allude to it, I believe. So if there is, and that's why I'm always pushing for it, get started with something, get validated, get that initial business case validated, and then scale and go from there. I think the more FOMO on one side, but through a direct experience in the crypto space, people are able to see, the more revenue they can generate, starting with things that are very simple, all the way to things that are harder, more complex. I think the easier it's also going to become to have a proactive conversation with the regulators, especially in those jurisdictions where the regulators aren't proactive themselves, and ultimately start generating a lot more of this internal change management, which I think is needed, as opposed to pure technology, which I do believe that technology is a bit more advanced than the culture is.
Sure. I mean, I couldn't agree more with the points that you made just there, but I think if you're picking on the business case and being able to make the business case is one of the sort of key enablers, I think that's one of the challenges that we really see. And I think to Mico's point earlier, you know, prohibitive regulation actually does impede on a P&L if it doesn't allow for it, and it might differ from jurisdiction to jurisdiction as well. And I think coming back to that point, particularly for institutions and demonstrating to your C-level, it's actually like, well, how are we going to make money out of this? And so you need to be given a bit of room, room to maneuver, so that you can demonstrate that there is a revenue model there that, you know, further down the line might get us somewhere. But all that to say, I mean, love the discussion that we had, and we're picking up a new custody work stream at the moment. So I'm really glad that the challenge section is going to be as long as it was 2-3 years ago. But anywho, I think that one of the things that I just wanted to start the wrap up on was focusing on, so, you know, where we are now in terms of some of the implementation challenges that you'll went into wonderful detail with, but looking at how, you know, I think bridging the tech service provider with the institutional perspective is something that really came through in the conversation just now, and sort of the illusion of joint forces when, you know, approaching regulators and policymakers and trying to find and harmonize fit-for-purpose frameworks. So Laurent, for example, in the relationship Standard Chartered has with its subsidiaries like Zodia, Custody and Markets, how has that helped sort of a lot of the work that you've been doing in terms of pushing the digital asset dial within Standard Chartered?
So it's always a question of strategy, I have to say. So it's built by a partner. So we believe that digital assets are here to stay. If you are just looking to the market capitalization, not today, because I can see that today it's not a good day for crypto, but a week ago the market cap was at $3.5 trillion of US dollar. It's a growing market. The demand is here. We can see with ETF, ETP in Europe, and so on. So crypto are here to stay. After, it's all about strategy, I have to say, because if you are doing nothing, the other will do. So in terms of crypto custody, you have different possibility. You can build something from scratch. You can partner. You can use, for example, we use Zodia in our capacity. So it's a standard chartered solution, and we use Zodia as a service. So it's a kind of partnership with them. And the idea will definitely to have an extension of our custody. So why I am here today in Stanchart, Luxembourg, it is definitely a key extension for the securities services. We have the client, we have the connectivity, and the idea will definitely to be there tomorrow and to have a solution for all of our clients. But it's more a question of a partnership, so definitely.
I couldn't agree more, and I think it brings us to sort of a nice wrap-up conclusion part, which is really, I mean, all of the work that you guys are doing with counterparts, I suppose, depending what hat you're wearing and what that really means for, I suppose, the 2025 outlook, but really looking forward at what capital markets is becoming. So it'd be lovely to just get your concluding thoughts on the role of cross-industry collaboration within that and what it means for the future of finance and capital markets.
So on the counterparty side, I will also elaborate on our relationship with the Galaxy. So as I mentioned before, Galaxy acquired us in 2023, and I think the beauty of this joint forces is that Galaxy are very much specialized in participating from the business and services perspective in so many projects, and we are specialized in providing the needed infrastructure to support it. And it comes into play in a lot of exciting things that we are doing these days. For example, we are working together on the All Unity project with the Deutsche Bank for its fully regulated Euro stablecoin project. It's a joint forces with Galaxy and with them. And we provide the full technology in order to do that, all the way from the tokenization, the issuance of the smart contract to support the stablecoin, and then the custody of the tokenized assets. So that's just one example. In general, as technology providers being backed by publicly traded company, I think it's a true value because banks and other traditional institutions that looking to work with us, it provides them with a lot of confidence to know that everything is transparent, there are earning calls and no surprises. And also we share together some services for the market also toward 2025. So, for example, Galaxy has a notes validator services business units, and we provide from our custody technology what we call impenetrable staking, where we delegate the keys to Galaxy as node providers, as notes validators, and together we provide a full suite of staking services to our clients. So, yeah, this counterparty, I would say parent company, is very exciting for us towards the
On our side, as mentioned in the beginning, we got acquired in 2021 by Deutsche Börse, and Deutsche Börse is probably one of the better European positioned market infrastructure providers. So they ultimately want to enable the asset classes to grow, in some cases in a somewhat agnostic way, right? So they operate, etc., and a lot of the crypto products are listed there. There's all sorts of custodians out there. There's all sorts of custodians that operate different technologies behind the scenes, etc. So I think at our group level, they're very much focused on making sure that the asset class can grow. Horizon 2026, which is their strategic outlook, has made one of the three pillars digital assets, some of which revolves around crypto finance. So ultimately, my expectation for the future is going to be more collaboration, sometimes directly, because providers of technology will work with custodians to ultimately enable the banks to come into the space. Obviously, there's more collaboration on topics such as staking. There's more and more cross work there. I think the future is going to be multi-custodial in some cases. So there's going to be shared clients. But what I think is really going to start happening more and more is you're going to see the traditional custodians come into the space, start rivaling the crypto native custodians, and it's no longer a matter of, hey, do two custodians compete with each other, but it's also a matter of what type of custodial model is going to rival the one that the different teams want. And quick thing, depending on who you talk to, generally innovation teams, which are more fond of technology, will be looking for sovereignty and self-custody. Generally, business teams will instead be looking for outsourced, keeping things as simple as possible. So I think the commercial models will be changing, prices will be changing. I don't think security has been fully priced in because maybe there hasn't been a big enough scandal out in the market. So that's going to be interesting to keep that track record going.
Yeah, I guess I'll be quick. I think the wild card is DeFi for me personally. We're seeing slow but persistent growth of decentralized exchanges, decentralized lending platforms. I think there's still gaps in DeFi to make it more kind of regulator-friendly. Dirty pools, or at least questionable pools of liquidity, are a constant concern. But, there will be solutions to that. But we're also starting to see much better technology kind of through account abstraction, paymasters, and so on, that allows us to provide a Web 2 experience without the risk of a central provider. So we've launched a Web3 wallet initiative and so on. But I think, I think centralized services will be here for a long time, don't get me wrong. But potentially the cost optimization by not having large teams operating and relying on the security of the blockchain is going to be transformational to the CapEx. And we may see major disruption in the industry 10, 15 years from now.
Maybe very quick.
Very quickly, please.
Yeah, 2025 will be the year for regulation and strategic change in Europe, thanks to MiCA. And for me, the first mover in the tokenized money market and also in the institutional crypto custodian will be the key winner in 2-3 years' time.
Yeah, I would agree with that. Mico, any last very quick thoughts?
Yeah, a very quick one. Many more banking players stepping in. For the existing players, a lot of effort in understanding MiCA and working with the regulators. I'm also expecting banks to directly deal with the e-money token issuance and stablecoins in Europe in the next 2 years. And collaboration over issuance, custody, and distributing tokenized assets together with the asset managers.
Yeah, I couldn't agree more, and I think we'll touch on many of those topics in the panel that I'm on in a couple of hours. So thanks all of you for wonderful insights here today, and hope everybody enjoyed the conversation. Big round of applause, please.
Thank you. That was brilliant. My goodness, what a full...